Welcome back to the Ultimate Trading Podcast for beginner traders. I'm Isabel Maria, and today we're diving deep into a topic that, frankly, separates the traders who survive in the markets from those who burn out before they ever see consistent results: limiting exposure. Now, if you're new to trading, this might sound like a simple concept: don't risk too much on one trade, but I promise you, it's deceptively complex. It's not just numbers, it's psychology, discipline, and strategy all wrapped into one. Let me start by painting a picture for you. Imagine it's Monday morning. You've had a few winning trades last week, confidence is high, and you're staring at a chart that looks like it's ready to take off. A single tech stock catches your eye, it's trending upward, momentum looks solid, and your gut tells you this is your next big win. You decide to allocate 50% of your portfolio to it. That's your exposure right there. Now, fast forward 2 days, the stock gaps down after disappointing earnings, and you watch nearly half your capital vanish in hours. Heart racing, palms sweaty, the first thought that pops into your mind is, I can make this back. Sound familiar? That's exactly what high exposure does. It amplifies not just potential gains, but potential pain, and often, it triggers emotional decision-making that sabotages rational trading. So let's break this down. Exposure in trading is simply how much capital you've committed to a single trade or asset. High exposure means a significant portion of your money is tied to one position. Low exposure? That's when your capital is spread across multiple trades or asset classes, giving you a buffer against a single catastrophic loss. The dangers of high exposure are multifaceted. First, there's market volatility. One sudden price swing can wipe out months of gains. Then there's lack of diversification, which increases the risk that a single underperforming asset drags down your entire portfolio. We can't forget emotional stress either. The psychological weight of knowing that so much of your capital is on the line can lead to fear-driven or greed-driven decisions. And finally, liquidity issues. If your positions are large and less liquid assets, exiting can be tough without moving the market against you. So what's the solution? How do you limit exposure effectively? There's no magic button, but there are several practical strategies. The first is diversification, spreading your investments across multiple sectors, asset classes, and regions. The second is position sizing, which is a bit more technical. Let me explain with numbers. Suppose you have $100,000 in trading capital. You decide that for each trade, you're willing to risk 2% of your total capital. That's $2,000 per trade. If a stock has a stop loss 5% below your entry price, you calculate your position size by dividing $2,000 by 5%, which gives you $40,000. This way, no matter what happens, the most you can lose on that trade is the amount you've predetermined, $2,000. Now, imagine trying this without limiting exposure. Suddenly, emotions take over, and you find yourself putting $50,000 into a volatile stock. That's how disciplined position sizing saves you from catastrophic losses. Stop-loss orders are your best friend here. Think of them as automatic seatbelts. They don't prevent accidents, but they prevent you from being thrown through the windshield. Predetermined exit points prevent small losses from snowballing into portfolio-destroying events. And it's not just about using stop-losses blindly, it's about placing them logically, based on market volatility, support and resistance levels, and your own risk tolerance. And let's talk about risk-reward ratios. A classic rule is aiming for setups with at least a 1-to-3 risk-reward ratio. If your stop-loss risk is $2,000, your potential gain should be $6,000. This ensures that even if only half of your trades are winners, you can still come out ahead. When exposure is properly managed, your portfolio becomes resilient. You can take calculated risks without fearing the next market swing. Now let's revisit Sarah, a real-world example from my coaching experience. Sarah started out with 100% of her portfolio concentrated in tech stocks, 40% Apple, 30% Microsoft, 20% Amazon, 10% Tesla. During the tech boom, she was ecstatic, her portfolio looked amazing. But then, the tech sector faltered, and suddenly, she was watching huge losses pile up in real time. She realized that her emotional response, panic, frustration, even a touch of desperation, was driving her decision-making. Sarah's solution? She limited exposure. She rebalanced. Tech stocks now made up only 30% of her portfolio, healthcare 20%, consumer goods 20%, financials 10%, bonds 10%, and gold 10%. What happened next is exactly what we hope for when exposure is managed. When tech dipped again, losses were cushioned by gains in other sectors. Volatility decreased, emotional stress eased, and Sarah could make rational, deliberate decisions. Over time, her portfolio produced consistent returns, not because she avoided risk entirely, but because she managed it intelligently. I want to pause here and stress a psychological point. Limiting exposure isn't just a numbers game, it's an emotional safety net. When you know no single trade can destroy you, your mind stays calmer, your decisions are cleaner, and your performance improves. This is where trading psychology and risk management intersect. Now, some practical steps you can implement immediately. First, assess your current exposure. Look at your portfolio and ask, could a single trade take out 20% or more of my capital? If yes, it's time to rebalance. Second, apply strict position sizing rules. Decide how much you're willing to risk per trade and stick to it. Third, use stop-loss orders, and place them thoughtfully, not arbitrarily. Fourth, regularly review your asset allocation, ensuring it remains diversified across sectors and asset classes. Fifth, maintain a risk-reward mindset for every trade, and finally, review and rebalance your portfolio regularly, because markets evolve and positions that were once safe can become dangerously concentrated. I'll leave you with a quote from Tudor Jones, one of the legends of trading, who said, "At the end of the day, the most important thing is capital preservation." Limiting exposure isn't just about making money, it's about surviving to trade another day. Without that, no strategy, no insight, no winning streak matters. So, here's a question for you. Take a hard look at your current portfolio. Are you truly limiting exposure, or do you have hidden concentration risks that could devastate your capital if a single market event goes against you? Comment below with your thoughts. I'd love to hear how you're applying these principles. Remember, trading is not about hitting home runs on every trade, it's about disciplined, calculated steps that keep you in the game for the long haul.
Thank you for listening to the 101 Trading Tips in the Ultimate Trading Podcast, brought to you by bellsforex.com AudioWorks. We hope this episode gave you insights, perspective, and practical ideas to strengthen your trading mindset and improve your decision-making. Stay disciplined, keep learning, and remember, every trade is a step toward building your edge. If you found value in today's episode, don't forget to like, subscribe, and turn on notifications. Sharing the podcast with fellow traders helps us grow and bring even more free trading education to the community. Visit us anytime at bellsforex.com for resources, guides, and tools to support your trading journey. Until next time, trade smart, stay disciplined, and keep building your edge. Happy trading!